Welcome to The Explainer. So today we are unpacking PennyMac's fascinating Q1 earnings report. And you might be wondering, why PennyMac? Well, because it's the absolute perfect case study of what happens when cutting-edge AI collides head-on with a pretty brutal interest rate environment. If you really want to know where the real estate market is heading right now, and frankly, how it affects your wallet, you've got to look at what PennyMac is doing. Let's dive in.
Right out of the gate, there's this massive paradox we have to talk about. It's the tension at the very heart of their quarter. How does a mortgage giant actually thrive when its core servicing business takes a massive hit? The answer is essentially this brilliant, high-wire balancing act between high-tech efficiency on one side and a completely unpredictable economy on the other.
Here is our roadmap for today. First, a Q1 earnings overview. Second, mortgage production and AI gains. Third, the servicing segment squeeze. And finally, their future outlook and strategy.
All right, Section 1. Q1 earnings overview, the baseline numbers.
So PennyMac delivered a really solid $82.3 million in first quarter net income. To put that into perspective for a second, they are effectively acting as a giant shock absorber for a highly volatile housing market. If you look at their adjusted net income, it's an even stronger $117.7 million, which gives them an 11% annualized return on equity. The big takeaway here? Their baseline foundation is incredibly sturdy. And, management is quite literally putting their money where their mouth is. Chairman and CEO David Spector leveraged his belief in the company to repurchase 560,000 shares for $50 million during the quarter. In the finance world, buying back your own stock is basically the ultimate signal that you believe your company is undervalued and sitting on a gold mine. So let's take a look at what that gold mine actually is.
Okay, moving right along to Section 2. Mortgage production and AI gains, the tech-powered engine.
Let's take a closer look at exactly where this money is coming from. It turns out consumer and broker direct channels are absolutely dominating, combining to drive a massive 75% of their acquisition revenue. This fueled a segment pre-tax income of $133.6 million, which is more than double from a year earlier. Even though their total loan acquisitions were down overall, the profitability within these specific direct channels was just staggering.
Now, you're probably wondering, how are they actually squeezing out all this profit? Well, it is definitely not market luck. It's their relentless, aggressive integration of AI. After deploying their Vesta platform, they basically unleashed AI agents to handle fulfillment tasks. And here is the real jaw-dropper. Spector noted they are moving toward exceptionally low manual intervention and in some cases, completely removing human touch points entirely. We aren't just talking about a helpful chatbot on a website. This is total automation.
And the results of this whole AI takeover? They're immediate and they are highly measurable. In the first quarter, their refinance recapture rate rose to 22%, but by April, it approached 30%. Think about how agonizing getting a mortgage usually is, right? By using AI to close loans faster and massively improve the customer experience, PennyMac is retaining nearly double the refinances compared to late last year. By letting bots handle the heavy lifting with the paperwork, they didn't just boost their volume, they absolutely crushed their costs. Direct expenses in the consumer direct channel have plummeted 26% from 2022 levels. Meanwhile, the operating costs to actually service those loans dropped by 24%, to a mere fraction of a percent of the loan balance. Honestly, it's an absolute masterclass in efficiency.
Which brings us to Section 3, the servicing segment squeeze, the complex shock absorber.
Okay, to really understand the headwinds they're facing right now, we need to quickly de-jargon a couple of terms. Think of mortgage servicing rights, or MSRs, as the value of the right to collect your monthly mortgage check. That value jumps around wildly based on interest rates. Hedging, on the other hand, is simply the financial insurance PennyMac buys to protect themselves when those MSR values change unpredictably. Got it? Okay, let's look at the math. So it's essentially a classic financial tug-of-war. On one hand, higher market interest rates actually drove a really healthy $177 million gain in the value of their MSRs, but the cost of that insurance we just talked about, the hedge-related losses, wiped that entire gain out with a massive $221 million hit.
Yeah, ouch. That subtraction right there is exactly why the servicing segment's pre-tax income shrank down to just $12.7 million. For a little context, that is down sharply from $37.3 million last quarter and a far cry from the $76 million they posted a year earlier. Their total servicing portfolio also dipped 2%, down to $720 billion.
Now, you might be sitting there asking, why on earth would they take a deliberate $221 million hit? Well, because management is playing the long game here. CFO Dan Perotti deliberately dialed up their hedge ratio to near 100%. Think of it like buying premium hurricane insurance right before a major storm hits. You lose some money up front, for sure, but you guarantee the long-term survival and stability of your foundation over short-term servicing profits.
Adding to that squeeze were a few very specific corporate investments. The corporate segment actually posted a $41.5 million pre-tax loss. So where did that money go? Well, interestingly enough, $9 million went straight to marketing pushes for the Olympic and Paralympic Winter Games. They also spent about $3 million preparing for an upcoming massive subservicing acquisition of a company called Cenlar.
All right, that brings us to Section 4, Future Outlook and Strategy, the Long-Term Horizon.
So, what does all of this mean for the future? With AI creating these massive efficiencies on one side, but high interest rates stubbornly squeezing margins on the other, how exactly is PennyMac positioning itself for the latter half of the decade?
They are taking a really conservative but heavily fortified stance right now. They've actually lowered their near-term return on equity guidance for 2026 down to the lower mid-teens. Why? To aggressively fund more technology and brace for lower demand if rates stay high. Meanwhile, that Cenlar acquisition we mentioned is closing in the second half of the year, bringing in scale and diversification. And backing all of this up, a massive $4.2 billion war chest of available liquidity.
CEO David Spector made it super clear that these immediate sacrifices, these investments, and lowered expectations, they're just a calculated bridge. Once they cross it and their AI scale is fully realized, they expect to achieve massive long-term returns in the high teens to low 20% range. It's all about short-term patience for massive long-term gain.
I'll leave you with this thought to ponder today. As the entire mortgage industry races toward automation, what happens when everyone has AI? I mean, if machines are doing all the paperwork, how will lenders actually stand out to you, the home buyer? Will it just be sheer scale, brand trust, or maybe something we haven't even thought of yet? Thanks so much for joining this explainer, and definitely keep an eye on how these technologies continue to reshape our world.